Since its founding, Coldstream has been highly focused on a proprietary investment discipline, and as the industry has evolved over time, so has Coldstream's approach, including its tools and decision-making disciplines. Within my overview today, I will highlight some of the enhancements that we've implemented over the last year or two as well. So let's start by saying that our investment process starts by getting to know our clients. This is actually an ongoing process which continues over a course of a client's life and takes into consideration all the changes that life can bring. We seek to gain an in-depth understanding of our clients' needs, goals, and even dreams. A critical part of that process relates to jointly defining a client's risk tolerance. How your portfolio is allocated and its holdings depend directly on how much risk you're willing to take. As you can imagine, it would be a very different answer if we ask a client, how much money do you want to make by investing, as opposed to asking a client, how much risk are you willing and able to take? We do the latter. We can then build a custom portfolio that's positioned to address a client's personal situation. The remainder of my presentation will unpack the processes which support our deliverables on the right side of the slide, and those relate to investment and portfolio construction. Overall, our investment process is based on modern portfolio theory and the interrelationship of investment risk and return as conveyed by the efficient frontier. While markets can be unpredictable in the near term, they have been quite consistent over the longer term and through market cycles in terms of the relationship of risk and return. In order to pursue greater return potential, an investor must be willing and importantly able to accept greater potential risk. The efficient frontier as shown on this slide reflects the longer term risk-return relationship based on portfolio blends of the traditional asset classes of stocks and bonds. This chart is not merely an artist rendering, it's actually based on 28 years of data for US stocks and US investment grade bonds, so that's 1989 to 2016. And this relationship is consistent whether we measure risk as volatility of returns or standard deviation, or whether we consider downside risk or drawdown, which is a measure of declines from market peaks to troughs. We show 5 standard portfolio blends on this chart, but the relationship is basically a continuum. Stocks have consistently provided the greatest return over time, although stocks can also represent the most volatile asset class. And also stocks can exhibit sizable peak to trough corrections in the neighborhood of 50%, such as occurred as recently as 2002 and 2008. Owning just stocks present risks which are not suitable for most clients. It is for this reason that our portfolios typically incorporate diversification with asset classes that are uncorrelated to stocks. These are investments that zig when stocks zag, and also investments that don't go down as much in an equity market correction. Such diversification vehicles can include bonds and alternative investments, and we use those. This next slide presents a simplified overview of our portfolio construction process. So let's unpack it from left to right. Our opportunity set are the global markets and includes all asset classes. We do generally apply a home country bias. We also seek opportunities for diversification and return enhancement from all over the globe. Before we select specific investments, we are very intentional about our asset allocation. We are careful about allocation weights to stocks, bonds, and alternatives. And we are generally intentional about allocations within stocks as well. For example, domestic versus international, large caps versus mid caps, also even international developed and international emerging markets. And from Howard's presentation, you can see that overweighting outperforming segments and underweighting underperforming segments can be very important, as reflected from the recent dispersion between US and international stocks. To implement our asset allocation, we then seek the best of breed asset managers and funds from an open architecture. That means that we are not confined to just one or even a few fund management companies, but rather we search the universe of all available managers and funds to find what's best for our clients. More on the selection process a bit later, but first I want to unpack the asset allocation disciplines. So the overview is we have 3 segments in our allocation approach: strategic, regime, and tactical considerations. For strategic allocations, we base these on multi-decade considerations of risk, return, and correlations between the asset classes. When we determine our strategic allocations, we want to remain very respectful of the efficient frontier, and we seek to make allocation decisions that can favorably influence risk-adjusted returns through market cycles. Basically, that means core, long-lasting allocations intended to achieve either better returns or less risk as compared to the benchmark continuum that would be available from just standardized stock bond plans. Then comes the regime allocation. Coldstream has utilized strategic and tactical allocation disciplines for some time. If you've been a client for a while, you've probably heard us talking about those allocations. It's been over more recent quarters that we have fine-tuned and implemented a regime allocation approach. Regime allocations are based on multi-year observations of economic and market trends. We will review this discipline in the next slide, since it's something we just added. Then comes tactical allocations. These are based on multi-quarter indicators, particularly momentum and valuation. And recently, we've also considered policy. Implications around tax cuts and trade tariffs have been things that we've made decisions around. Tactical allocation decisions are intended to last for shorter periods of time and can be motivated as much by risk mitigation as well as by perceived opportunities for return. So now let's discuss a regime allocation discipline a little bit further. So asset classes behave differently at each phase of an economic cycle. And we believe that interest rates, inflation, and valuations are key drivers to what can be multi-year return cycles. We also observe that asset correlations can vary with economic conditions and risk tolerances. You can envision a risk-on market or a risk-off market when it comes to that. For these reasons, we believe it's very important to understand the current economic environment. Notably, our assessments of the global economies are not based on opinions of others or forecasts, but rather on objective data. We'd rather be a little late in confirming an economic trend with better probabilities of being correct, rather than try to be early and risk being wrong. In a confirmed recovery, direct your attention to the circle on the right. In a confirmed recovery expansion phase of the economic cycle, stocks work very well, as can high yield bonds and real estate. On the other hand, in a deceleration or recessionary time, stocks are vulnerable, and it can be prudent to emphasize safer investments such as investment grade bonds, even treasuries, and also alternatives that are expected to perform with little or no correlation to stocks. So armed with our targets for asset allocations, we then apply our manager selection disciplines to search for the best investments. We utilize active and passive strategies and funds while considering both the comparative costs and the visibility for our performance that the active manager may offer. By outperformance, oftentimes we focus on less downside risk, not just upside. We utilize also primarily external strategies, but we also offer select internally managed strategies where we believe we have core competencies. Our manager selection disciplines incorporate a couple dozen factors, both quantitative and qualitative. Some quantitative examples are shown on the right side of the slide. You'll see that we look at multi-year rolling returns. As you can see, we're gathering a lot of data here. We look at returns relative to the peers that also manage in the same space. We focus, as I said earlier, on downside capture many times. We also do stress tests of these managers. Examples of stress tests that we are running recently would be like the 2008 financial crisis, the Greek financial crisis, the taper tantrum of 2013. So we gather a lot of financial data, but we also look at qualitative data. We assess the fund management team and its tenure, the firm, as well as the fund's liquidity and other considerations. It takes a village to implement and maintain Coldstream's investment process. And actually more than a village, a team of highly experienced, seasoned, and passionate investment professionals. This team is what comprises the Coldstream Investment Strategy Group, or ISG, as we refer to it. It's now 13 members strong with over 236 years of combined experience. Coldstream's ISG meets collectively on a monthly basis and also operates out of 3 committees that focus on the discrete areas of asset allocation, manager selection, and private investments. I didn't touch on private investments in this presentation, but I will say that the due diligence that's applied by that team is very robust, including site visits, meeting with managers, as well as financial analysis. With private investments, we seek unique opportunities that are suitable for our accredited or qualified clients, particularly in the areas that are expected to be uncorrelated with stocks and bonds. Examples among private investments that our clients have participated in are real estate lending, as well as private real estate, also solar power, a blueberry farm, and most recently, distressed municipal debt fund. That completes my overview of our investment process. As you review your portfolios, you'll see the funds and investments that have been selected for you. And if you'd like a better understanding of how the asset allocation applies to your personal situation, we suggest you contact your portfolio manager.